When you've traded, you've probably heard of the term Fibonacci retracements, but what does it mean? Well, let's look at the underlying concept behind it. A man named Leonardo Fibonacci discovered a simple series of numbers that created ratios describing the natural proportions of things in the universe. This simple series of numbers is called the Fibonacci sequence. And how you get there, and how you form it, is you start with 0 and 1, and then you add these together, and then you get a third number, which is 1. You add these together to form the next one, you add these together and form the next one, and so forth. The really special thing about it is that when you get to the higher numbers, you can get any number, let's say 34, and divide it by the succeeding higher number, and you would always get 0.618. Also, if you measure the ratio between alternate numbers, you would get 0.382. You can use 55 and 144 for an example. There's also another more important ratio, and that is the golden ratio. And you can find that by finding the last number, let's say 144, and dividing it by the second to last number, which is 89, and you would get 1.618. The reason why it's called the golden ratio is because it is found in many natural objects. Why use Fibonacci retracements? Fibonacci retracements work on the idea that when a new trend begins to form, the price will retrace back to a previous price level before resuming in the direction of its trend. Fibonacci retracement levels can be used as potential support and resistance areas, and they are best used when the market is trending. So let's say the market is trending down. You should enter a short on a retracement at a Fibonacci resistance level, and when the market is trending up, you should enter a long position or a buy on a retracement at a Fibonacci support level. How do we find Fibonacci retracement levels? Well, to find Fibonacci retracement levels, you have to find the recent significant swing highs and swing lows. So what is a swing high? Well, this would be a swing high, the highest point reached in a period of time you're looking at. And a swing low would be here. So when you're in an uptrend, what you're meant to do is you click on this swing low, and then you drag the cursor to the most recent swing high, which is this one. And then the software that you're using should produce something like this with each Fibonacci level. Just so you know, 0.5 isn't really a Fibonacci level, but it is usually included. Anyway, what you can see here is that the 38.2% one, or the 0.382, was tested, but price was unable to close below it. So it then went back up, resuming the trend. But if you're looking at a longer time frame, you'll see that this became a significant support level, being tested 1, 2, 3 times before carrying on the uptrend. Drawing Fibonacci retracements in a downtrend is similar to the uptrend. You click on the swing high, which is the highest point, and you drag the cursor to the swing low, which is the lowest point, and your software should generate something like this with each of the different Fibonacci levels. As you can see here, price broke through the 23.6% level, or 0.236, broke through the 0.382 level, or 38.2% level, but when it got to this level, the 50% level, or 0.5, which is not an official Fibonacci level, but it's still included. It started to slow down, and then as you can see, price after that went back down. If you look closely, you can see that at Fibonacci levels, it can act as support and resistance, as here, the 23.6% level, price bounced back off, going back up to here, where it went back down. Using Fibonacci retracements alongside support and resistance levels can increase the likelihood of us finding a good entry. What we will do first is draw our support level right here. As I've mentioned before, support levels often become resistance levels. So we've drawn our support level for this price over here, as you can see, and stretched it out across. Now we've drawn our swing high to swing low, and we have this with all the different Fibonacci levels. So as you can see here, price often is pushed back below the resistance level and is unable to close above it. This is really important, as you can see that this is a very strong resistance level. Also, when you couple it with the Fibonacci retracement level of 61.8% or 0.618, you can see that it's very, very strong. And so anywhere here would be a very good sell entry. Because and what makes it even better is that you get multiple tests, 1, 2, 3, 4 tests of this level. So each one would provide a good opportunity for the sell, which eventually led to the price going down. Using Fibonacci candlesticks with Fibonacci retracements can increase your accuracy when you trade. Because looking at this chart, we've drawn our swing high to swing low, and we have all the Fibonacci levels here. And so what you should know is that from the bottom you can see a strong bullish engulfing candle. So you would know that it's going to break past the 23.6% level, or 0.236. And then you can see that there's some hesitation right here, almost a doji, which is showing signs of exhaustion in the buying pressure. But price continued to go higher. But why is this, and how can you avoid getting caught out here? You can wait for confirmation, because as you can see, there was a shooting star here, which suggests that there is a bearish reversal coming now. And next you have a red candle with almost doji-like shadows, equal length above and below, followed by another longer shooting star, after which the price began to fall. We use Fibonacci retracements when the market is trending, so it would make sense to use trend lines to increase the accuracy of our trades. As you can see, we've drawn our swing low to swing high, and then the software generated this with each of the different Fibonacci levels. But we've also drawn our trend line. As you can see, the trend line intersects the majority of the Fibonacci levels. This is important because when price begins to retrace, this is a very key area, as you have traders looking at the trend line looking to buy, and you also have traders looking at this Fibonacci level, the 0.51 or 50% level. So this makes it almost self-fulfilling that when it hits this level, it will go up. And that's exactly what it did. It began going back up. Fibonacci retracements are just like any other indicator. With so many people using it, it often becomes self-fulfilling. And so what that means is that if loads of people are looking to buy at, let's say, the 0.382 level or 38.2% level, then it'll most likely bounce off this level. Thank you for watching. I hope you enjoyed this video. You should now be able to trade using Fibonacci retracements. Don't forget to like and subscribe. And an Arabic proverb says that sunshine all the time makes a desert.